On April 22, 2026, AMERISAFE reported its first quarter earnings. By the end of the trading session, the stock had dropped 10%. The sell-off was triggered by a second consecutive quarterly earnings miss. Operating earnings per share came in at 50 cents, falling short of the 55-cent consensus. The market reaction pushed the equity through a major psychological barrier, plunging it to a new 52-week low near $30 a share, levels unseen in 13 years. If you only look at the income statement, the pessimism seems justified. But analyzing the liability structure on the balance sheet reveals a severe disconnect. The company operates with literally zero long-term debt. There are no covenants, no maturity walls, and no refinancing risks hiding in the footnotes. This volumetric diagram illustrates the resulting mathematical anomaly. The large block represents AMERISAFE's highly liquid investment portfolio, valued at $774 million. It entirely swallows the smaller block, which represents the company's current market capitalization. You can buy the entire business for less than the cash and investments it holds in reserve. We have to determine whether this equity is a terminal value trap, or if the market has irrationally priced a cyclical trough, creating a deeply asymmetric investment opportunity. To understand the mispricing, we have to look at the actual product. AMERISAFE provides pure-play specialty workers' compensation insurance for small to mid-sized employers operating exclusively in high-hazard industries. Construction makes up roughly 48% of their book. They send field safety professionals to physically walk job sites and review blueprints to assess risk. They insure logging operations, where claims are infrequent but carry an extreme catastrophic tail risk profile when accidents do happen. They maintain a heavy presence in transport and trucking, where a single workplace accident can result in a multi-million-dollar payout stretching over decades. They also cover maritime and port operations, which present highly complex liability environments where standard algorithmic underwriting models typically fail. When a generalist carrier's system sees these physical jobs, the algorithm automatically declines the coverage due to the catastrophic risk. Because of this risk density in sectors like agriculture, AMERISAFE manages severe injury claims through specialized adjusters rather than relying on generalist call centers. Across these heavy manufacturing and industrial settings, the company relies on 40 years of proprietary actuarial data tailored strictly to these specific niches. The institutional knowledge required to accurately price these catastrophic risks creates a narrow operational moat that competitors cannot easily replicate with new technology. To prove whether that moat is holding, we have to check the combined ratio. In insurance, this is the definitive metric for evaluating if a company's core operations are profitable. This formula calculates the combined ratio, losses and expenses against premiums collected. In Q1 2026, AMERISAFE reported 93.2%, an underwriting profit. Compare that to competitor Employers Holdings, posting a catastrophic 112% ratio, losing 12 cents on every premium dollar. Despite the market panic over headline earnings, AMERISAFE remains strictly profitable on every dollar of premium it writes. The market's anxiety is rooted in a valid macroeconomic problem. The workers' compensation industry has been trapped in a soft pricing cycle for 12 consecutive years, mandating continuous premium decreases. This vice grip compresses margins. Top regulators are cutting rates by up to 9%. From the bottom, claim severity is spiking aggressively due to medical inflation. In 2025 alone, AMERISAFE recorded 25 individual claims exceeding $1 million each, up from 18. This simultaneous drop in premiums and rise in costs resulted in severe financial damage, cutting their free cash flow by 61.8% in 2025. They face the structural risk of tight labor markets, pushing younger, inexperienced workers into hazardous roles, driving up claim frequency alongside elevated severity. The margin compression is a brutal reality. It legitimizes the market's fear that the combined ratio could soon breach 100% and turn the underwriting engine unprofitable. To evaluate if management is accurately pricing these mounting risks, we look at long-tail loss reserves. Because catastrophic injuries take decades to settle, insurers must set aside capital immediately based on estimates. This timeline charts how those estimates hold up. The accuracy of the initial claim reserve is the definitive test of an insurer's underwriting discipline. In the first quarter of 2026, AMERISAFE recorded $7.6 million in favorable prior year reserve releases. This means that claims from previous years are currently settling for significantly less money than management originally modeled. Consistent favorable development is receipts-in-hand proof that management is pricing risk conservatively. They are over-reserving for damage, not recklessly underpricing policies to chase volume. This brings us back to the balance sheet. Holding $774 million in liquid assets with zero debt lets management absorb bad claim development and wait indefinitely for the pricing cycle to turn. While AMERISAFE waits, competitors operating with 112% combined ratios will eventually bleed out capital and exit the high-hazard market entirely. We are already seeing this consolidation. AMERISAFE grew its in-force policy count by 9.5% year-over-year, while others retreated. A new CFO arrives in May 2026, bringing fresh eyes to a highly liquid balance sheet with massive room for capital allocation maneuvers. By capturing market share from exiting competitors at the bottom of the cycle, AMERISAFE is establishing significant operating leverage for the moment pricing normalizes. The bear case is straightforward. Severity is rising, rates are falling, and the dividend math is getting tighter by the quarter. Yet, in the exact same quarter the market treated as a disaster, AMERISAFE generated the metric you see here, a return on equity exceeding 13%. It achieved this while its market capitalization remained priced below the liquidation value of its investment portfolio. At roughly $30 a share, the market is pricing in a permanent terminal decline. But with a zero-debt balance sheet, the conservative reserves, and the profitable underwriting margin, the asymmetry heavily favors patience over panic for a 3 to 5 year horizon.